Good morning, or bonsoir, good afternoon. I'll wait. I am early. I'm just going to check my settings. Let me know if there's anything wrong with the sound. Bonsoir. I sent an email with the link to the playlist, so you can always see the current lecture when you go there. And that's how you're going to find me each class, okay? I also sent 2 documents of exercises, and I will send you the solutions to those documents as well later. I want to try them without the answers first. How is the sound? So I'll wait for at least 10 people. It should be 15. I'll wait for 15 people to show up. Bonsoir. So I will wait a little longer. It's 1 o'clock. It's still early. Well, it shouldn't be, but I know people come in a little bit late. But let's not make that a habit so that we can start on time and end with good time. Did any of you have a chance to look at the materials, or you're going to be looking at them for the first time now? I understood that Taylor was going to assist in reviewing exercises on Saturday afternoons, or Saturday mornings, and maybe it didn't happen today, but I've been sending him the materials, and I'll be in touch with him about that. If anybody knows, please let me know. I haven't heard from him yet. I heard from him weeks ago, but not recently. So if the screen does get blurry, just refresh the page. Or if what I'm saying does not align with what you're watching, that means you should refresh the page. So you all had some great questions yesterday. The one that sticks out, and I think is still unresolved, is where does the interest rate come from? And I debated spending some time on the derivation of the interest rate, but if it's necessary, I'll do it later, talking about the market actors. But essentially, for now, let's just take the interest rate as given. And it is already sorted out by the investor that if they were not investing in this opportunity, they would expect a rate of return of 8% for each dollar invested. So if they didn't get it here, they would get it somewhere else. And this example of the real estate market is a good one. You have an opportunity to invest in real estate. The individual faces an 8% interest rate. It means that they want to earn 8%. Otherwise, they'll just go to financial markets and get the 8%. So in the example, I give you only one interest rate with the understanding that that is the one the investor has identified as their expected rate of return or required rate of return. So I'm going to use several different names for this idea of this rate of return. It can come up as, in this case, we refer to it as an interest rate. But if I solve the problem looking for the present value of an amount, we often call it the discount rate. The present value of a future amount. You can also refer to it as the required rate of return. So all of these are referring to that implicit interest rate. Maybe you've heard it called market rate. It's very important, you can see, in making our calculations. So depending on the context, it takes a different name. So shall I begin? I have 15 participants. Okay, so we left off here, and I told you, yes, we have our answer. We should not buy the hotel because we would earn the investment of 8% in the market, which exceeds what we'd get in the value of the house by 5 year time. So then I said, well, we have the answer, but I want to demonstrate how we would do a financial analysis computing the net present value. instead of valuing these assets, this lump sum and this house, hotel, rather than valuing them at current time, I figure out the value of those investments at time 5, end of year 5. But in finance, we prefer to, I have 2 on a page like you do. What we prefer to do is put together this amount, the investment, against the future value at time 0 and determine the net present value. So I'm going to offset the present value of $4 million by the price of the hotel. And then the value is determined here, and you can call it in time $0. I can refer to them as time 0, year 0, or today. Or now. Sometimes I call it now. So here we have in the box is the net present value in general. What we do is we take the initial cash flow, which is in cash flows, that's out of pocket investment, that would be a negative, you see? And then we add you add the present value of future cash flows. I have a question. The evaluation that you'll assign to us for 4 weeks will be in group or individual? Oh no, it's individual. Individual work. Individual work. I will be giving you many documents that you can practice together in the group. Okay? So you'll see, I just sent you some question papers, and you can practice those together. And then the assignments should be completed individually. I know that's going to be difficult, but I'm counting on you to complete your individual work. And keep in mind that when you copy somebody's work, you might not be copying the right answer. So there's always that. So depend on yourself and build your understanding, okay, your own comprehension. I leave it to you. It's the honor system. All right, so back to this. So I can put this in my calculator using the scientific keys, the regular keys, and then what I'm going to do is show you how to do this using the cash flow keys. So if I want this on my calculator, I would have to take 3 million, so 3, 1, 2, 3, 1, 2, 3 with a negative. And you know what? I'm going to store that in the first memory bank. And then the other amount is the 4 million. I'm going to use the discount factor of 1.08 to the power of 5 years, and then I'm going to invert it and multiply it by 4 million. So that's one way to enter that manually. So here you have, this is the present value of $4 million, where the prevailing interest rate is 8%. So I have the 3 million that I spend, and then this is what in terms of present value dollars, this is what I will make for owning the home. That's the value, present value in 4 years, or 5 years, sorry. So what I want to do is recall the first one, and I want to add the present value of future cash flows. And this is the net amount. So this is the net present value. So that's how I can calculate that using my storage keys for each term. And it can get tedious if you have many terms, right? If you had many more, and that's very possible. You might have interim cash flows here to consider, and we'll look at that example. So as it turns out, this one, this is the right answer. And since it's a negative, it means that it's less than 0, which for the net present value, the rule is don't invest. So what you've done is you've figured out the benefit against the cost, accounting for time value of money, that $1 in the future is not as valuable as $1 today, and you've determined that this is not profitable. It's not profitable at all. Oh, I already asked the question for the evaluation is that you will work individually for the homework. I mean, for the assignment. But I am going to be giving you several exercises where you can practice in group solving problems and studying together. And as I mentioned, I believe Taylor is going to be available to help you with that. I need to confirm that, though. I haven't heard back if that's going to happen. So what I'm going to show you next is how to enter this into your calculator using the CF worksheet, cash flow worksheet. Here is the formula that your calculator by default will use. Notice there's no cash flow at time 0, but we have to indicate it in the calculator. There's no cash flow at time 2. What did I just say? There's no cash flow at time 1 or 2 or 3 or 4. Only at year 5 are we going to see that the value of the asset by potentially selling it. So we're going to work together to enter this into the calculator using the CF keys to determine the net present value of this investment opportunity. So I begin with the first cash flow. The first cash flow is the purchase. So it's $3 million. Enter to CF0 and then down. So I begin this by hitting CF. Let me start again. So this is CF. That's not 3 million. And I want to clear it. Let's clear that. So I'm going to write 3 million with a negative, enter it, and that's the first or initial cash flow. And then scroll down, and I said there would be no cash flows until the 5th year. So it's going to be 0 in there. And I have to tell the calculator that. So 0, enter, down, and F stands for frequency. So how many zeros are there? For now, I'm just going to put 1 in each time period. Enter, down. So now I'm in the second time period. The second time period, I'm going to enter 0 again, and then down, and go down again. I'm going to enter 0 again for the 3rd year, and go down, down, and then enter for the 4th year, 0, and I get to the 5th year. In the 5th year, we will sell, or potentially sell, for $4 million. And I enter it, there's one amount of 4 million, and I'm done. So I have finished entering in the cash flows, and I can see them here. I've entered the initial cash flow with a negative 3 million. The first one, the second one, the third one, the fourth one, all 0. And then the 5th one, $4 million. So once I'm done, I hit the key that says NPV. You see that? But there's nothing there because I have to tell it what is the interest rate I'm using What is the required rate of return I'm using? I'm using 8. I'm going to enter that and scroll down and now ask the calculator to compute. And that number looks very familiar. So please repeat these steps and see if you can get the same answer. The steps are outlined here. How's it going? Let me know if you've got the answer. Let me know. Indicate if you got the answer. Any comments? Can you get the same answer? So another way to do this is realizing that we have 4 of the same value. In fact, that's frequency of 4. There's 4 zeros. So I could bypass these steps by putting 0 and then for F or frequency putting 4 instead. So that's what I want to do next, and I'll show you we can get the same answer. I'm going to go back to CF and I'm going to second clear work to start over again. Tell the calculator that we will be making a $3 million investment, enter down, and then there will be no revenue or expenses for 4 years. So there's going to be 0 entered for a frequency of 4 periods. Enter. And then, even though this says CO2, this will be the last year where we offset by the present value of that property, which is $4 million. And I enter it, and I for a frequency of 1, and I'm done entering value. So I have just 3 million negative cash flow, 0 for 4 periods, and then $4 million at the end. The negative sign is, oh, let me see if I can let you see where the negative sign is. It's not very well positioned on here. See on the bottom? There you go. So, if I go back, so this, if you make 3 million, 3 and 6 zeros, you can add a negative and take it off. That's the negative sign down there. Samuel. All right, so I have all my values in CF. They're still stored even though I cleared my screen. Here are all the values as I explained. And now what I want to do is get the NPV. So I hit NPV and it's not there because I need to put the interest rate in first. So I enter 8 as a percentage interest, enter, down, and then tell the calculator I want you to compute the NPV for me, and I get the same answer. Let me know if you need it again. That's all. We're on to the next. I need some feedback to know. All right, so we found this answer. And the conclusion is we should not invest because it's not profitable to invest. What if, however, you can let me know if I should slow down. What if, however, we see a timeline like this, where there are interim cash flows? What if we are able to rent the hotel to someone for third year and the fourth year and make some revenue? $200,000. Is this enough to offset the loss that we saw, or the the cost, economic cost? Let's see. We'll use the same formula, the net present value approach. And here we see, this is the formula now. And it should be enough to offset the initial cost. So going through the steps, you can work with the information already in the calculator if you didn't erase it, and include in the third and the fourth year 200,000. You'd have to change the 4 years of 0 to just 2, frequency of 2. So let's see if we can do that and get this result. Down here, what you see, it's a positive NPV project, which means invest. I need some feedback from you, or I'm going to continue. Not to be threatening, but I mean, I don't know if you're bored or if you need help. Let me know if you need help. Okay, so I have the values already in here. I hit CF for cash flow, and I start looking. Here I have 0, and it's 4, but I want to make it 2. Enter. And then for the second year, oh, so this is going to be confusing. So I want to make it 2, but then I want $200,000 revenue in the future for 2 periods. So that's 1 period of that, and then 200,000 for another period. And then I'm going to potentially sell the hotel, and that's it. So that's all the cash flows. I have 3 million expenditure, then 2 periods of 0, nothing happening, and then 2 periods of rental income, 200,000, 200,000, and finally I have 4 million. And now I ask for NPV. The 8 is still there. I ask to compute, I enter the 8. And this is the old answer, but I have to ask the calculator to recalculate. And there you go, positive NPV. So this is worth it. Okay, so continue. The steps are all there. What if we have a project then? We're not looking at a business opportunity like a purchase of a hotel, but we're looking at an investment opportunity here that promises these revenues. And let's say they're guaranteed. These are guaranteed revenues. These are guaranteed revenues where the required rate of return is 8%. So again, this indicates what the investor would invest in. He would invest in financial markets at 8% if this was not profitable. Okay, so that we're going to compare them. We're going to do that. How we're going to do that? It's a little bit similar, but it's a little different from the net present value. I do want to discount all these amounts back to time 0, just like these formula here, this one here does. Each of the amounts are discounted back to time 0. But in this case, I don't know the initial price. I want to know, what is it worth? What is it worth what should I pay today to earn these amounts over the next 5 years? Where my option is to invest in financial markets and earn 8%. So what I do in this case is I set things up. I can do it 2 ways. I can set things up here where each amount is discounted appropriately for the number of years that have transpired, and here is the price or the initial investment for that security or investment opportunity. And I want to figure out, what is the break even? What is the fair price? What's the most I'd be willing to pay so that there's no profit? Okay, so 0. And then any price offered, anyone asking for less than that would make it a profitable investment. I could, mathematically, you can see I could switch these around and write the expression this way. And this way makes it easier for me to work with my calculator to find out what is the price. So if I put the 0 here, this one becomes negative. So the absolute value of this or the negative of this CF, let me just write that down. So this is a negative because that's the initial investment. And so this would be a positive because it's a negative times a negative. So now I can enter these amounts, this and these amounts, into the CF keys of the calculator and determine what the fair price is. It would just be the net present value. So what the net present value is of this gives me the value of this deal. So we do it this way because it's tedious to enter each term into our calculator alone. So I will give you some time. Please let me know when you get the answer. Put it in the chat. Okay, I'll let you have a few minutes. Now, if you're not using the finance calculator, it's your prerogative, but you're missing this opportunity to make things so much easier. Okay, how did it go? Did you enter? So let's see about entering this. I will clear up my CF keys. So CF, second clear work, and start to enter 0, enter down, and 1100, enter down. And there's only one of those, so it's individual amounts. 2500, enter down, down. And then 3400, enter down, down. Oops. I touched a different button. So I have 3400, enter, and then down. And then the fourth one is 40, 50, enter down, down, and 1000, enter down, down. And then finally, ask for NPV, put in the 8%, enter down, and compute NPV, and there's your answer. So this represents the NPV, and this is how much an investor, so it's like the profit, and so that's how much, that's the most that an investor would be willing to pay for this investment. So because it's supposed to be a negative amount, it's out of pocket as a cash flow. It's that amount. How's it going? Someone tell me that you're okay, or you're lost. You want me to slow down? You want me to speed up? Please tell me some feedback. Okay, no feedback. Jefferson, Samuel, tell me. Luxo, what's happening? Feedback. Okay, great. Francette. One more time. So I'm going to clear work second. Clear work once I'm in the CF keys, and I begin entering the values. I begin with 0 first. That's the key thing. It's 0 first, enter, and then scroll down. Then 1100, enter, scroll down, and there's one frequency, one of those down. So now we're on the second. 2500, enter, and scroll down twice to get to the third one, which is 3400, enter twice, and then 4050, enter twice, and 1000, and I'm done. And I can check that I've got everything entered properly. 1, 2, 3, 4, and 5. And ask the calculator to compute NPV, enter my interest rate with enter, scroll down, and ask to compute NPV. And there it is. Okay, so you have 6. Yeah, maybe you missed the negative. Oh, you have. I'm not sure what you did, Jeffson. So scroll through your keys. Scroll through and see. It should be 0 first. You need to have a 0 first. Then 1100, 2500, etc. I'm not sure what you did because your answer is smaller. So we begin with 0. Let me know, Jeffson, if you figured it out. So it should be 0. C01 is 1100 with frequency 1. Make sure it's frequency 1. C02 is 2500 with frequency 1. C03 is 30,400 with frequency 1. And the fourth cash flow, that's what it means, is 4,050 with one frequency. And finally 1,000 for one amount. And that's it. And then you ask for NPV. You put 8 inside. If it's not there, you enter 8, enter, scroll down, and compute. And I have the same answer. They didn't change. All right, so hello, Anouk. Yeah. Yeah, if you don't get the negative sign, it's very problematic. Okay, should I continue? Very good, very good. Okay, success. All right, so we have done this problem. Now, that was a very general case where all the cash flows were different. Is there a simpler way to do this when the cash flows are the same? Here I have shown you, this is the expression for NPV, where all the cash flows are different. So I denote them with a different subscript to indicate they're all different. I mean, they could be the same, but not necessarily. Okay, they could be all different. So what I'm going to show you now is how we can find a simplification formula for the case where some cash flows are the same. Like when you pay your mortgage, you pay the same amount. Or when you receive a pension, you could receive the same fixed amount. Okay, so that would make those identical, and that creates a pattern that we can compute a formula for, derive a formula for. In addition, I've just demonstrated here that cash flows are finite. There's no more cash flows than time duration T. But in fact, there are investment opportunities where the cash flows accrue forever. So we want to learn how to deal with infinite cash flows as well. So I'm going to appeal to your math skill and your memory in this discussion. You will see things that look familiar. And we're going to focus on just a few applications. And you can see in the formula sheet that I shared with you, really there's only about 6 formulas that I need you to know. And they're actually all related. So here's our first example of a case where a bond is available. What is a bond? Can someone tell me what a bond is? Maybe it's not so clear. Well, a bond is an investment instrument or vehicle. It's a contract with the seller. In this case, well, it can be a government that sells bonds. It could be a corporation that sells bonds. In this case, in Britain, there is a consul bond that is purchased and promises, it's a contract that promises to pay $100 per year forever. So it's known as a British consul bond. It also implicitly guarantees a yield to maturity of 5%. So here's another interest rate term. So I'm going to stick with the same formula, although in different situations. For bonds, we refer to the interest rate as the yield to maturity. And it reflects the return on the investment given the price. So we have a different interest rate now to deal with 5%. And the question is, what is the fair price? What would you pay to have a guarantee of $1,000 forever? Sorry, $100 a year forever. So here's the timeline for that deal. $100 at the end of each year forever. So what is that worth? Now, I do have all the notes and you can look forward ahead, but think about it. Someone promises you, in this case the British government, promises to pay $100 at the end of every year forever. Why is that even a fixed number? Shouldn't that result be infinite? Shouldn't the present value of this amount be infinite? It turns out that no. And the answer comes from the fact that there is a time value to money. Eventually, at some point, the $100 off in the future, from the perspective of today, will be worth so little they might as well be worthless. So as long as the value converges before that happens, then you have a price on this asset. All right, so how do I figure out what the answer is? I'm going to use logic. And I'm going to say, imagine that you deposit an amount. I'll just call it PV for now. So you would deposit an amount, principal value, into a fund, and you're told that you'll receive 5% on that. That will afford that will give you $100 every period forever. So this fund will just sit untouched, and the interest is what it's paying out, the $100. Guaranteed a 5% interest or yield forever. So if this is the case, and this is the understanding or relationship between these variables, then the price should be like this. It's not infinite. It actually works out to be $2,000. So $1,000 forever, because of the time value of money, is worth $2,000 today. If it was the bond was selling for less than that, you should buy it, right? Because you're buying it a more valuable item for a discount, a lower price. So this doesn't happen. It doesn't blow up because of the time value of money. Eventually, we're adding zeros. So what I can take from here is derive a general formula what I did was I took the payment amount, which I will refer to as the first cash flow, and divide by the yield. So in general, you can use this formula, provided the elements are the same, that there's a constant payout forever, that the first payout is 1 period from now. That's how you read this subscript is now, and this is 1 period from now. So the first payout is 1 period from now, and then subsequent payouts will occur at the end of every period forever. And the yield to maturity doesn't change, it's always the same. So those are the criteria for this formula that's known as the perpetuity formula. So it's a very simple calculation. You just need to know when to apply it. So you don't need to use TVM keys here. You don't have to enter 100 infinite times to your calculator and to your CF keys. That's not necessary, okay? Because you're going to have the answer this way, using the logic that I provided you here, as though the amount is deposited into a fund for which it constantly pays 5% return, or the $100 each period at the end of the year, or in this case, end of the year, forever. So I've done that slide, and here is the description that you can see each cash flow subsequently gets smaller and smaller and smaller and slow. Without interruption, eventually we'll be adding zeros. So before that happens, these amounts sum and converge to $2,000 in this case. This is called a perpetuity. So, to summarize, and this is what you have on your formula sheet, you have a formula for perpetuity that looks like this, and it looks simple, but it's very loaded. Some things to point out, even though I've said them, I'll put them here. First cash flow 1 period from today. Next, cash flows forever. The cash flows are all the same. The same C1. And I remains constant, doesn't change. I think that's most of the terms. So that if those are true, then you can calculate the value of that investment that way. It's not, Anouk, it's not 20 years. Could be. I see what you're saying. Because it's $100 for 20 years. It's a good question. It's a good point. She's saying it's about 20 years. But in fact, because of the time value of money, as you see here, roughly, but you see it degrades very quickly. So it's more than 20 years. It's more than 20 years. Because these are not even $100 anymore after 4 years. Okay, so you're approximating that 100 times 20 makes 2,000. Maybe a little bit more. Should be a little bit more. But again, that's not true, because you're going to get them the 100 forever. Okay? You're going to receive the $100 forever. So how can you receive it forever when you don't live forever? Well, you pass it on. This is something you can pass on to your beneficiaries. You can bequeath this amount or this asset so that it can, or you can sell it. Or you can sell it. You can sell it and then give that money to your heirs. Or go shopping. Or whatever it is. Okay, so cash flows are forever. It's good comments. Okay, so let's see here. Let's apply this to stocks. All right, so what's a stock? So a company, corporation, operates with, or it finances its operations in part by taking shareholders. Now, the shareholders in the company are both investors, but they are also beneficiaries of the returns to investment in the company, right? So shareholders in a small company, it could be just the owner, could be the proprietor, could just be the shareholder, or it could take a partner, maybe a friend, or someone who does complementary services, or take them on as a partner and give that person some share. So it could be a partnership where you share, but in a corporate structure, shares can be sold in what's called a public company, and shareholders could just be unknown to you. Individuals who want to buy ownership in your company that give the company some capital, some money, so they can finance their operation. So that is realized. Those shares are sold initially in an initial an IPO, an initial public offer, and then after that, the company allows those shares to sell on the stock market. So buyers and sellers of stock can meet in the various variety of stock markets and they can deal to purchase shares after the initial public offer. Okay, so in this scenario that I'm presenting here, ABC Incorporated just announced that it plans to grow steadily, and it will pay stockholders $100 per year. Let me just check something. Did I miss something? Hold on. Make sure I didn't miss a slide. Okay. So let's go back. So ABC Incorporated just announced that it plans to grow steadily and will pay stockholders $100 per year per share. All right. So what happens with stockholders is they can get dividends from the company. So there's no guarantee that they'll get dividends if they own what's called common stock. And the company can decide whether the manager, the executive of the company can decide whether they're going to share profits with the investors, the stockholders, or whether they will reinvest that money in the company. Okay, so those are decisions that a corporation will have to make. And if stockholders are unhappy with the decisions that the executive and management make, then they should show up at the meetings, the meetings where stockholders can vote on who is part of the board for the corporation. And in effect, they have a say. So they can either sell their stock if they're unhappy with the operations being conducted and the way they're being conducted, or they can show up and vote out the current board. The board of directors is responsible for hiring management that run the company. Okay, so there's the board of directors, hires and fires the managers. So if you don't like things the way they're going and you're a stockholder, you can sell your stock. And unfortunately, if the other people feel the same as you, they might not want to buy your stock, so they'll offer you a lower price for it, right? Than maybe you had in mind. Or stick with the company and wait for any opportunity to vote out the board of directors or members of the board that are causing trouble and hiring the wrong sort of staff. So you want people who can take charge. So you often see when chairman of the boards retire or they leave a company, that affects stock price. So there's a lot of these details about stocks in the textbook that you can read about. I mentioned the chapters you can read, and I think it's chapter 3. Anyway, I put it in the syllabus, and you can read about stock more there. I really want to apply this for a quantitative evaluation of the stock. So what I want to do is use this information of this announcement. Announcements by corporations influence the stock price immediately. All right, because investors react. They decide if they want to give up or sell their stock based on things that are happening, or buy more, or buy at a profit because the firm's doing well, and sell their stock in the company. So things change when there are announcements. So we look at announcements. They plan to pay stockholders $100 per year per share starting next year, and then 2% more each year indefinitely. given a required rate of return of 5%. Wow, there's lots of information here. What we really want to see, is there a pattern that we can identify that can help us to mathematically value the stock? So now, every asset is worth the initial investment plus, or let's say it this way, every asset is worth the present value of future cash flows. That's what you're willing to pay for it. And if it's offered for less, then it's a bargain. Okay? So we want to figure out the future cash flows to stockholders in ABC Incorporated. So here are the future cash flows. Never mind what happened in the past. I'm here as a prospective investor. Maybe I have stock already, and I'm looking at this thinking, what is the value of a share in ABC Incorporated? It's $100 per year, but then it grows by 2% each year, and this happens forever. So this is a pattern for sure. It's a perpetuity, but it's a perpetuity, we call it a perpetuity with growth. Now it's more valuable, right? You agree it's more valuable. These amounts are greater each year, potentially offsetting the effect of time value of money. So we have to take note that if the cash flows exceed the erosion factor of money, then this could become infinite, right? This could become infinite. So let's see. Given a required rate of return of 5%, what is the fair price of a share of stock? So let's see. Notice this. See, for stock, I is called the required rate of return for investors. So I'm going to make a note here. I for stock is the required rate of return. Now, this is a perpetuity, so it should look something like the one that we had derived before, except this feature where this multiplication of a growth factor, you see this is accumulation, looks like accumulation factor, but this is now called a growth factor. And you see how it grows steadily. Here you have a exponent 1, here you have 2, and so on. So this is what's happening this time. Each amount is discounted just to show you, to demonstrate the time value of money effect. Notice that the first one, 95, 24, is similar, like it's the same as what we had before, but now the second one is higher than we had before when there was no growth. Okay, so this is gonna, this growth effect is slowed, the growth effect slows the erosion of cash flows that occur over time. So what we actually do is use this to come up with this formula here that looks very much like the one that we used before. All we do is offset the effect of erosion by the growth rate in the denominator. Now, this can only be true, this is the formula you should use, provided the condition is met. I must exceed G. If not, if the growth rate exceeds the required rate of return, or the erosion factor, or the opportunity cost, however we have so many names for I. If it exceeds, then this is not going to happen. These are not going to go down. And the amount, the price of this asset will blow up. So this only exists, and this is the formula, only if I is greater than G. So you have to make sure that's true. Otherwise, and you won't see this, if I is not greater than G, or in other words, the growth exceeds I, the price will be infinite. So that won't happen. That won't exist. In efficient markets, if such an asset existed, well, it won't exist because infinite price, no one can pay that. Okay? So this will never happen. So this formula only applies when I is greater than G, because this can't happen. Questions? So this formula and the timeline that I'm showing you appears on your formula sheet. Now I want to do the same thing that I did with the perpetuity formula, and this one being called the perpetuity with growth is slightly different. I want to point out the conditions of the formula. So first, let's get this one here and see. I'm going to take this one from here. I like that I can do stuff like this on the iPad. I just don't know where I'm going to fit it. Okay, let's see. Make this bigger. Okay, these were the conditions for the other formula. The first cash flow, one period from today, correct. And see it in the graph. The cash flows are forever. Correct, forever. Cash flows are all the same. This one changes, okay? We have to change that. Cash flows are not the same. What they do now is they grow at a constant rate of G. I'm going to just take over. I'm not sure where to put this. I'm going to try to make this shrink this, and then move this over here. Let's try that so you can see. It's very important that you know when to use these formulas. Okay, so what I'm going to do is I'm going to write that again. Just going to make this a little bigger before I write it. Okay, so cash flows grow at constant rate C, G. All right. So, and finally, I is constant. I doesn't change. So all I changed was that they're not the same, but they grow at a constant rate, G. And now you can use the formula. And is this crooked? No, looks good. Okay, so this formula, the timeline, what you see is one period of before the first cash flow. Oh, and I guess I should say that growth starts in the second period. I'm going to add that too. Okay, so the growth starts at the end of period 1, or maybe it's better to say growth starts in period 2 to avoid confusion. So it's like the perpetuity, but it's a little different. So this is different and this is different. So first cash flow, 1 period from today. Cash flows forever. Cash flows grow at constant rate G. I is constant, and the growth starts in period 2. Okay, so the first cash flow comes, and then the growth kicks in. It's very important you know the pattern. Now, let me see. I need to bring these two together. Okay. So in this problem, this is the timeline we've already discussed. So you need to put $100 as the first cash flow. The growth rate is 2%. The interest rate is 5%. So there's 2 rates here. You got to be clear about which is which, right? The required rate of return is the I. But this one is the G. And you see in the timeline, so I'm going to ask you, when these problems get complex for the test situation or the assignments, you should present to me your timeline so I can follow your logic. Any questions? So you see, this is more than $2,000. It's $3,000, but it's not infinite. It's not infinity. Okay, it's 2:20. Let's take a little break. Let's take a 5-minute break. You guys can ask me if you have questions. Let's just take a 5-minute break. Somebody needs to get a snack, some water. You have a question for me? Okay, I'm back. Questions, comments? Questions or comments? Everybody okay so far? So again, the interest rate, the required rate of return being used for valuing this project, valuing the stock, the interest rate, the required rate of return an investor is using is an amount that he or she perceives that they would like for this investment. And if they can't get it through this investment, they will use the financial markets to find it, the 5%. So this is the 5% represents their willingness to trade off the investment of $3,000 for future consumption. This is the price that they will do it at. So it's like a price. Okay, so next. Notice I haven't used the financial calculator. I have not used the financial calculator for these perpetuities. There are no special keys on the calculator to compute these amounts for perpetual cash flows. You just have to use the formula, enter them scientific calculator. So let's see if you had any trouble with this. No, I don't think you will, right? 100 divided by, so just make sure that when you calculate, you simplify your calculation. My experience is that students can make these calculations. Just don't forget there's no, for perpetuities, you can't use your finance calculator TVM keys. So this is better than sitting and entering these forever, right? That's not even feasible. Can't do that. So we have this simplification that captures, because of the pattern, it captures the value. Okay, so what if the simplification formula doesn't apply? What should you do? So for instance, I've mentioned here that I has to be greater than G. Okay. In that case, it has to be greater than G. It won't work at all, won't be meaningful. But I will demonstrate to you in general, if simplification formulas, and I'm going to continue to give you some more, if they don't apply exactly as I've stipulated, the conditions that are required to use them, then you should use the mixed cash flow formula. That is this approach. Go to the, use the basic fundamentals here to try and sort out your answer. If payments are indefinite, it's kind of hard. It is hard. So let's see what I'm talking about in those terms. Here we have for infinite cash flows. Yeah, we've done infinite cash flows. What if cash flows are not infinite? They are finite, but there is a pattern. If there is a pattern, we can still take advantage of it. So for instance, here's a loan. So a loan has been acquired to help you make your car payments of $100 for the next 4 years. The effective, and it's monthly. It's monthly. The effective monthly rate of interest is 1%. how much did you borrow? So what's the value of that loan? I want to know, how much did I borrow if I'm able to make $100 payments forever? I mean, for 48 months, not forever. Well, this is not forever, right? It's for a fixed number of months. So the formula that I use actually looks very similar to the perpetuity formula that I introduced you to, but we are going to adjust the formula to exclude future payments not made. So I'm going to show you how I do that. Bear with me. This makes more sense when you understand it, but let's see if I can get you to understand. So here is the timeline in general for a perpetuity, right? This is C1, C1, C1 forever at the end of every period, and this is the value of this stream of cash flows. I refer to this as present value A, because what I'm going to do now, to just get this portion of cash flows, I want to exclude the cash flows that will not occur. So what I want to do is use the fact that these future cash flows at time t similarly can be valued using C1 over I. That's the perpetuity formula. However, this happens at period t. So in the future, so what you need to do with cash flows off in the future is discount them to today. So this is the discount factor to bring this amount back to today. And what I'm going to do is subtract as though I have all the cash flows forever and just take off the ones that are not going to occur. So when you do that, you get a new formula. This is called an annuity. This is the formula for annuity that's actually programmed in your calculator. You can access it using the TVM keys. So what did I do here? I subtracted the perpetuity by the discounted perpetuity that starts at t years. And then this is the formula in the box. So what I want to see whenever you use this formula is that you have presented the formula with the values indicated. This formula corresponds to this timeline. It looks like a perpetuity, but it stops. It's not infinite. It's a finite number of cash flows. So I'm going to finish this. I think the rest of the class will be working with annuities. And we might even get through these notes in the next hour. Any questions so far? Let's apply the annuity formula. Here's the exercise with the car loan. So these are the cash flows that occur through time for 48 months. What is the value of those payments? I must have had to borrow how much? You borrowed $3,797.40. I've put in for C1, that's the initial cash flow, that's the interest rate, and then there's this adjustment factor that occurs because I'm using the formula for perpetuity, but it needs to be adjusted for the fact that it doesn't go forever. And there you go, 48 months. And I use the interest rate. Notice the monthly interest rate, there's some keywords here, effective and monthly interest rate. It needs to be the effective rate. The formulas on the first formula sheet includes the effective rate. So it's just called an effective rate because that's actually 1% per month that accumulates at the end of each month. So you would write in the elements here, and you could punch this into your calculator, but it's quite tedious. The way I would do this is I start here and I would do this, but I'm going to show you a better way. I'm going to show you a better way to do that. So I'm going to first go to my TVM, second clear TVM, and show you I can enter this annuity now using payment. You see now we're going to use payment. We never used that before. We only entered amounts into these, but not the payment. I would have put a 0 in there because you have to override every single key. Before I do that though, I'm going to show you how I would do this if I use the scientific keys, not the finance keys. So using the scientific keys, I would go 1.01 and say power 48. And then I would invert that. I would put a negative in front and add 1. And that is the adjustment factor that I multiply to $100 and then divide by the interest rate, 0.01 here. And that's how I get that amount. Would you like to see that again? So for this exercise, it was for 4 years. So 4 times 12 is 48. Just to say, formulas use effective rates and the timing of payments should match, must match. The compounding frequency to use my formulas, you have to match the compounding frequency with the timing of payments. So here it's monthly interest accumulating and the payments are monthly, so it works. So let's go back what I was doing. So I hit 1.01 and I put it to the power of 48 periods, and then I inverted it for made it a negative and added to 1. So that's the adjustment factor for the perpetuity. The perpetuity, that is times 100 divided by 0.01. Now let's use the TVM keys to get the same answer. So I'm going to store that so I can compare it to what I get with the TVM keys. In TVM, it's 48 periods, so I put that into N. The interest rate, I'm told, is 1, so I put 1 into interest. And the payments now are 100, and I receive those, so that's, no, I make those, so that's a negative payment. And PV is what I want, so I left it blank, and I went to payment. And now future value, I don't want that. I'm going to put 0 and compute PV, and I get the same result. That's the same result that I just got. Should I do it again? Okay, one more time. Again. So let me clear TVM, second, clear TVM. Oops, second, clear TVM, and clear the screen. Now, 48 is the N, because that's the number of periods. Interest is going to be 1%, so I put that into interest. PV is what I'd like, so I leave that blank. And then I make a payment of $100 every month, so that goes into payment. And I don't want FV this time, I want PV. It's always one or the other, right? So far, I put 0. I have to override future value, put 0 in there, and then ask to compute PV, and there's my answer. So as I mentioned, do not write those procedures down for marks on your test, but you might want to write them down on your paper so that you have a reference. So it's no problem to me if you want to write them down. It's not a problem. I'm just not going to give you credit for writing those down. So here you have all the details: 48 into N, 1 into interest, PV left blank, negative 100 into payment, and what you get out is that this is the loan you receive. Cash inflow positive $3,797.40. Put a dollar amount on it, and that's your final answer. So for a test, I want to see this, and I want to see this. You get no points for this, but you can write it. Okay, next. I'm going to start here, page or slide 49, unless you have questions. I will go back in an instant. Okay, are we together? All right, let's look at this exercise on slide 49. What if payments, now we're talking about payments, occur at the beginning of a period? What do we do? For instance, you sign a 5-year lease to rent your office space to a dentist for $1,200 per month to be received at the beginning of every month for 5 years. The effective monthly interest rate you agreed to is 1%. So this is what you're charging. You agree, you negotiate with the leasee. What is this deal worth to you today? So this is important, right? Because you have this opportunity to lease, but maybe on the other end, somebody's offering to buy the office space completely from you. So how do you compare? Well, you need to find the value of this deal. So let's find the value. It's $1,200 every month at the beginning of the month, which makes sense because leases are paid at the beginning of the month. So how does this change? How does this change things? Let's step back a moment, back to this formula, and let's do the same thing that we did here where I stipulated the criteria. Actually, I'm going to go back to the original one over here. Let's look at this criteria. Take it over with us. And notice the pattern, okay? So the first cash flow occurs in one period from today, so that's the same. Cash flows forever, no, that's not true. So let's erase that, or let's fix that. So cash flows are just for T periods. And cash flows all C1, yes, that's true, and I is constant. Okay, so these are the conditions to use this formula that align with this timeline. So it's pretty much like the perpetuity, wasn't it? All I changed was this, that they're finite. So let's see the annuity here is not the same because the first cash flow is not in one period, it's immediately. So how do we adjust for that? This is called an annuity due. Okay, the first payment is right now. So how should I adjust for that? Well, maybe couldn't I just use a regular formula for one less period and then just add this amount in? That's one alternative. So actually there are 3 ways to do this that I will demonstrate. And then we can work on the exercises that I have. Or maybe I'll leave the exercises to tomorrow and I'll just plow through this material. All right, so are you seeing what I'm seeing? So this amount here is the problem. This does not match the formula we already had. So I go through the steps to derive a formula for annuity due this amount forever would be C1I, and I'm using a star because of this extra term. I'm ignoring this extra term. And and notice this is in the last exercise where I showed you the proof for annuity, this ended at T, but now it's at T minus 1 period before, because the entire pay schedule is shifted back 1. Still, this formula is true. This is the perpetuity that happens, starts at T minus 1, so I have to discount T minus 1 periods. Subtract this by this amount, so to subtract the full perpetuity by the payments that don't occur, and then add back this term. So this formula looks very familiar. What's different is this term here and the fact that I use 1 less, because the 1 less is paid now. So you could use your calculator to get this part with 1 less payment, and then you have to remember to add this amount in. Or you could use your calculator in begin mode as though it's a regular problem for annuity, and you would get the right answer. And there's one more method I do want to discuss with you, because it's a technique that's useful for solving problems, time value of money problems in general. So although this is the formula, right? This is how you would use you could use your cash flow keys and go through this and punch them in, but there's no need. This is actually programmed on the calculator. You just have to tell the calculator it's 1 less and then add in the extra term, or tell the calculator that you want to make payments in the begin mode and enter things as though it was a regular annuity. So what I'm going to show you are the 3 methods, okay? So the first method, if I'm going too fast, let me know, because I think I'm going too fast. Method 1, page 52. Let me wait for you. So I'm just really repeating myself. Let's start here. Method 1, how do we solve this? Okay, I'm going to go back for Jeffson. I have to see where I wrote that. Okay, here. So the criteria to use this formula, the regular annuity formula, is the only difference between it and the perpetuity is the cash flows are the end. They're fixed at T periods. So this ends here. It doesn't go forever. You have 3 dots here, but that's just in between. That's not indefinite. Yeah, they're all C, you see? They're all C1. Okay. All right. Let's see. So back to this one. I've amended the formula, shifting the cash flows back a period. And so what I'm going to do is just adjust the annuity from 60 payments to 59, and that will give me the amount of future cash flows in present value terms, but I have to add back the 1,200. So I enter everything as usual. All that I change is this 59 is different and this extra term. So there's the 59 here and then the extra term here. So the value of leasing it is $54,485.51. So if somebody made an offer for the office space of $60,000, that would exceed this amount, and that would be a better deal, wouldn't it? So by calculating this, you can compare to other alternatives. Now, this is just in dollars and cents. Maybe there's other value or other things that could be done with the space that's not being considered in this valuation. You'd have to include it to help you make this decision. All right, but given the information, it's only worth $54,485.51. If you know of other potential deals to rent it out, then you'd have to add that in. So this is just going on what's written here. Let's say there's no other leasee, that's all there is. So let's see. So that's method one. So let's put this in our calculator, see that we can get the same result together. So notice I can do this algebraically, or I can do it with the finance key. So let's try it first algebraic. I would write 1.01 to the power 59, and then I would invert that, put a negative in front, and add that to 1. So that's my factor, adjustment factor, for the fact that the payments are finite, not infinite. And then I divide that by 0.01. So that's that term. Did I do something wrong? Try that again. That's got to be wrong. Let me try that again. 1.01
to the power 59 and then flip it with a negative in front and add it to 1, and then multiply that by 1200 divided by 0.01. And that is just the second term. Then I have to add in the extra, the immediate payment of 1,200, and that is my result. So that's how I would enter it with the scientific keys. If I was to enter this using the TVM keys, I would start from left to right. Let's see, I'm going to clear TVM first, so second clear TVM, and begin with 59. The interest rate was 1, and then let me make sure the interest rate was 1, right? And then I want the PV, so I won't put that in. And the payments were 1200 and 0 I leave blank, so I can compute PV. Now this is just the present value of future cash flows. That doesn't include the first one. Now notice it comes back as a negative. That comes back as a negative. So you need to turn that off before you add in the 1200 to get the answer. Okay, let me know if you need any help. I'll put up the, let me put up the steps. And I refer to that as method 1. Okay, let's see how you're doing. How's it going? I'm going to add to the statement that I made.
So I'm just going to change that to say that didn't work. Okay, so if you don't see any other value in the office space and someone made an offer of $60,000 for the space, you should sell it. But in fact, you could probably do something after the 48 months, right? With the space, so you'd have to include that in. All right, so have we got that? You guys will have ample time to practice, promise. So let's see, second method. Second method is to just enter everything as per usual, but put the calculator in begin mode. So turn the calculator to begin mode and then enter it as though it's 60 periods. The calculator will make the adjustment for you and give you the answer directly. So this is much easier, but you have to remember this. Don't forget to put your calculator back into end mode. How did you do with that? So let's see, 60, let's do the same thing, go back into here. I'm going to clear TVM, second clear TVM, and enter 60 periods. Oh wait, I have to put it in begin mode first. Well, I guess it doesn't matter. Let's enter it as 60 and 1 interest. Leave PV blank because that's where I want to, that's what I want to find. And then 1200 in payment and override future value, ask for PV. Now this is the wrong answer because I didn't put it in begin mode. So let's see if I can put second begin, second set, and now it's begin mode. So I asked to, will it work if I just hit PV? Oops, let's clear PV. No, it didn't work. Compute PV, there. All right, so you can do it before you begin the question or after you've already entered the variables to set it to begin mode. Don't forget to unset it and be careful with the sign. You need the sign just to tell you that it's the cost of that investment as I entered it, this is the opportunity cost, right? And what, for the purposes that we need it, we would just use the positive version of that. Notice there's a BGN symbol in the upper right corner, which we need to suppress. So for the next problem, we need to prepare second, begin, second, set, and turn it off. And here we go. So let's see what's next. This is the third approach. Oh, notice, let me say something here, that
you should put all of this together in a formula. So you need to know this formula, and you should add it because it is not on your formula sheet. I'll let you add that in. So you should add this onto that's the sheet that I gave you, one of the documents I gave you yesterday. You will need to show me the formula with the values entered and your final answer. All right, so we are here. If you have any questions, let me know. So I'm not sure about the programming of the calculator in order to make the right calculation. But I suspect that once you say begin, it's making a very simple adjustment, and that is the one I'm going to demonstrate to you now, and this is method 3. If you look at these cash flows, remember the rule to use the annuity formula is that the first cash flow occurs 1 period from today, but that doesn't happen. The first cash flow is now. However, I could apply the regular annuity formula if I wanted the value 1 period before. So notice this timeline, as I mentioned when I introduced the timeline, that it goes forward and back. So I could find the value, I could find the value 1 period before and then adjust it. Okay, so let's think about what's happening here. All these values are related through time, right? There's a time value of money effect, and I want the value here at time 0 today. That's a conventional approach in finance. The calculator, once you turn it to begin mode, will be calculating in the regular way for 60 payments, but then what it's going to do is shift over 1 period of accumulation. So whenever you've calculated an amount, so we did see this amount, right? It was 53,000 something, where I used 60 payments with 1,200. So let's do that. Let's do the 60 payments with 1,200 again. So 60 payments with 1%, leave PV empty, and then 1,200 in payment. And when you compute the present value, you get 53,946. It's a little bit off. Now it looks like, oh, it's not so off, it's not a big deal, but banks operate in millions, billions, trillions of dollars, so these numbers amplify. So you want it to be correct. Let me see that again. So 53,946.05, 53,946.05. So this is 53,946.05 and whatever else. So all I've calculated here is this amount. Oh, I wrote the wrong number. I said it, but 53. $946.05. But then that's the wrong answer, right? Well, it's because this amount is valued 1 period before what I want. So in terms of time value of money, just as I can discount amounts, I can also accumulate amounts. So if you accumulate that amount by one factor, one accumulation factor, you will arrive here at the right answer. So you can take that times 1.01 and you get the correct answer. Okay, so you get the same answer. Questions? So I show you how to get this on your calculator, method 3. So you use that annuity with 60 payments, but then you accumulate it one period. Otherwise, it's too small. It's ignored the fact that the first cash flow has arrived. So this is another way of writing the formula for this. Okay, so we've learned a lot. Maybe I can stick with annuities a little longer. I sent you some problems. I sent you some exercises, which I'll send you the solutions for. Maybe we can take a pause and look at those, and then later I can work on the coupon bonds and things. All right. So let's see. I'm going to open up one of those documents. I don't know, I thought I did bring them over. Well. Okay, so let's see what you guys can do with everything you've learned. So I'm going to leave this up. So this is the document number, what document is this? 3. Document 3. This is document 3. So try this exercise. Tell me what you get.
Any comments? Any comments? $150,000 will grow to $1 million in 10 years. What is the implied annual effective rate of interest? So you can use algebra. Notice my instructions here. Show all your work for part marks, including timelines. Do not round any intermediate calculations. Please circle your final answer. See, follow the instructions. Final interest rate answers should be rounded to 4 decimal places if expressed as a decimal, or 2 decimal places if expressed as a percent. So you can do this algebraically, and then we'll do it with our calculators, finance calculators. So this is $1 million divided by 150,000. And that means that. So you're going to have 100 divided by 15 to the 10th root minus 1 equals I. That's one way to get it. So you get I of 20.89%. Very good. Somebody got it. Let's see who got it. Harry. Very good. Now let's do that with the calculator. So this looks like PV 1 plus I T equals future value, T. So I can enter from left to right 10 into N. Interest is what I want, so I'll leave it empty. Then PV is 150,000. That there. So PV is 150,000. And there are no payments in this exercise. This is an investment, so I'll put it as a negative because that's a cash outflow to earn $1 million in the future, which is a positive. So if you enter these and you compute I, you get 20.89%. Samuel, this is a power function here. It's not a multiple. So this is like that's what it is. So if you want to put that in your calculator like that, you have to use brackets. I mean, it is 0.1. It is the power 0.1. So 10, 100 divided by 15. Is that what it is? It's 100 divided by 15. So 100 divide 15 equals to the power 0.1. What did I do wrong? -1. I did it wrong. Did I do something wrong? Yeah, I did it wrong. This is not 1. This is root 15. Why am I blanking on this? Root 10. So isn't that, let me get that straight. No, that's what I did. That's 0.1. It should work. I must have done something wrong. Let me try it again. 100 divide by 15 to the power of 0.1. There it is. -1. That's it there. Again, 100 divided by 15, and then you want to take the 10th root. But 10th root is 1 over 10, which is just 0.1, so I use the power button, 0.1, and then subtract off the principal amount, and that is my rate, 20.89. So I can also write this as which is equal to 0.02, no, 0.2089. And circle your final answer. So that's just the basic formula that I use, the basic time value of money formula. Questions? You have to tell me if I need to slow down. Okay, so I'm going to let you work on those exercises yourself. The rest of them, I just started you off, and I want to pull up the other assignment or the other problem set. And it's number 4. And this is for annuities. So I've given you the answers. It's a matter for you to attempt the exercise. Okay? So you have the answer. And I'm going to share with you the written full solution later. This says you receive $1,000 for 4 years, starting 4 years from today. So this is delayed annuity. It means that we have to modify our annuity formula. Just like we did for the annuity due, where we got the payment today, we didn't wait a year or wait a period. We need to modify the annuity formula to suit us in this case. So this is an annuities review, so I do want you to use annuities. Now you might be able to find a faster way to get the answer, but that's not the point of this assignment. I want you to apply the annuity formulas. So what I want you to do is start with making a timeline. This says in 4 years you start receiving this money. Is this even? I guess so. So let's start 0, 1, 2, equal intervals. Let me try that again. 2, 3, 4, 5, and I need to keep going. So you have $1,000 received for 5 years, starting 4 years from today. The prevailing interest rate is 8%. What is this worth? So you can imagine this is an opportunity that you will receive money. What would you pay for this opportunity? That's the question. What would you be willing to pay? And I want you to solve this using annuities. Even though you could potentially use the cash flow keys in your calculator to solve this, you can find this answer very easily. I want you to present it as an annuity. So by the rules we established to use those formulas that I showed you, we would be able to value, using those formulas, one period before the first cash flow. The first one is in 4, so I can find the value one period before. That's all I know how to do with the formulas. Then I have to make adjustments. So you need to apply the formula where it fits the timeline. So I can write, this is the annuity of 1,000 over, remember the formula for annuity, right? It's going to be PV0 equals C1 over I, and then the adjustment, that's the adjustment factor. So let's see. The I here is 8%. So there's my perpetuity, but now the adjustment, because it's not forever, it's just for 5 periods, I go 1 over 1.08, and that's to the power 5. And that is step 1. All we found is the value using the formula here. So you could enter this into your calculator using (5) into n and 8 into I, and then PV is what we want to find, so we don't put anything, but we put 1,000, and we are receiving, so we leave it as a positive, into payment, and we put nothing into FE. We're not interested in FE. So with that, we compute PV and get a preliminary answer. So you can do that here. 5, 8, payment is 1,000, 0 into FE, compute PV, and you get this answer, but that's not the right answer. That's just for 399271. And I should keep all the decimal places when I transcribe this number. I should actually store it in memory. I'm going to store it in memory 1. So it's 399271. I'm going to put that here. So this works out to be 399271 with many decimal places. And I'm going to put that into store 1. Now that is not the answer here. To get that answer, this amount, this represents all of these. This is the value at time 3 of these future cash flows. But what is the value today? Well, I need to just discount this amount back 3 periods to get that. That's how we find that. So that is because this is out here. So what we're going to do, I'm going to stop here because we're going to take a break, right? We're going to take an hour break, and then we will resume at 5 o'clock. So I will pick up from here. So see what you can do about this. Convince yourself that it's right, okay? And I'll see you at 5. Keep me informed of any questions you have. Okay, I'm going to close this link and we'll see you back here at 5, okay? I'm going to add a new link. Bye for now.